Here's the market reality nobody's talking about right now. Everyone's looking at the same 10 stocks, the same headlines, the same CNBC ticker. And while the crowd is staring in one direction, a completely different set of opportunities is sitting right there, undervalued, misunderstood, and quietly building the case that matters most in investing. Earnings growth at a price that actually makes sense. I've spent serious time going through the numbers, not just price charts, actual earnings reports, revenue growth rates, competitive dynamics, and what I found is that 5 companies right now are trading in a way that doesn't match what their fundamentals are telling us. Missing them? That could mean leaving real gains behind, not paper gains. Real ones. But before we get into names, I need you to do one thing. If you're not subscribed yet, hit that subscribe button right now and turn on the bell. We drop this kind of deep dive analysis regularly, and the next few months in this market are going to create some of the best entry points we've seen in a long time. You don't want to miss what's coming. Today we're breaking down 5 stocks. 3 that I think deserve your serious attention right now, and 2 that a lot of people are chasing that I want to walk you through very carefully. Because the story sounds good, but the numbers don't fully back it up. That contrast is where real investment skill gets built. Let's get into it. Before we name a single ticker, you need to understand the backdrop, because every stock exists inside a larger environment. And right now, that environment has some very specific characteristics. The economy is holding. Not screaming, not collapsing. Holding. Job creation is consistent. Consumer spending hasn't fallen off. And corporate earnings this quarter are coming in stronger than analysts expected. That matters. Because earnings growth is the engine underneath every stock price move that's worth anything. Interest rates are still elevated compared to where they were in 2020, but the trajectory has shifted. The pressure that crushed valuations over the last couple of years, it's stabilizing. And in that kind of environment, certain companies, especially ones with durable earnings power that got beaten down, start to look very different. One more thing. Artificial intelligence spending is not slowing down. The companies building large-scale AI infrastructure are still committing enormous capital to chips, data centers, and software. That spend creates a chain of beneficiaries, and finding the right spots in that chain is where a lot of the best opportunities live right now. All right, let's talk about the first company, Amazon. I know, you've heard the name 1,000 times, but I want you to forget what you think you know for a second because most people are still pricing Amazon like it's primarily an online retailer. It isn't. Amazon is a cloud computing giant that also runs the largest e-commerce operation on the planet. Amazon Web Services, AWS, is generating revenue of over $100 billion on an annualized run rate, and the profit margins on that cloud business, dramatically higher than anything the retail segment produces. That profit mix is shifting. Every quarter, more of Amazon's total earnings come from high-margin businesses. Here's what the numbers are showing. Operating income grew by over 60% year over year in their most recent report. Free cash flow, real money coming into the business after capital spending, is at levels the company has never seen before. And the valuation? When you strip out the cloud growth and the advertising business that's also compounding quickly, the price-to-earnings ratio starts to look a lot more reasonable than the headline number suggests. The catalyst that most people are underestimating is AI integration inside AWS. Every major company building AI applications needs cloud infrastructure. AWS is a primary beneficiary. That's a structural tailwind, not a one-quarter story. Now here's my honest concern. Amazon's valuation is not cheap on a simple price-to-earnings basis. You're paying for growth, and you need that growth to continue. If AWS momentum slows, the stock re-rates quickly. That's the risk you're sitting with. But for investors with a 2 to 3 year horizon, the earnings trajectory and competitive position in cloud and AI make a very compelling case. This is a buy with patience, not a trade. Quick pause. If this analysis is helping you see the market differently, hit that like button right now. It takes 1 second and it helps more people find this kind of content. Back to it. Here's where it gets interesting. Alphabet, Google's parent, has been one of the most misunderstood large-cap companies over the last 12 months. The narrative around AI competitors threatening Google search created a wave of fear selling. And that fear created an opportunity. Let me give you the actual picture. Google search is still growing. The advertising business that runs on top of it generated over $67 billion in a single quarter. Google Cloud is growing at over 28% year over year and is now consistently profitable. A huge shift from a few years ago. And Alphabet's total operating margins are expanding, not compressing, even while they invest heavily in next-generation AI. Here's the number that stops me in my tracks. Alphabet is trading at roughly 20 times forward earnings. For a company growing earnings per share at over 30% annually. That is an extraordinarily low price-to-growth ratio. Find me another mega cap with that profile. I'll wait. The moat is search intent. When someone types a query into Google, they're signaling commercial interest, informational need, or navigational desire. Advertisers pay a premium to meet those people in that exact moment. No platform has replicated that at scale. Not even close. The risk I take seriously here is regulation. Antitrust pressure on Google has been building in both the US and Europe. If a court-mandated breakup or significant operating restriction comes through, the stock sees a real impact. That is a genuine risk, and I'm not going to pretend otherwise. But here's my framework for sitting with that risk. Regulated businesses often become more predictable, not less. And even a restructured Alphabet would still contain some of the most profitable businesses in the world. At 20 times earnings with 30% growth, you're not paying for perfection. That combination is rare. Let's shift gears completely. Most individual investors aren't talking enough about Taiwan Semiconductor Manufacturing Company, TSMC. And that gap between attention and importance is exactly where interesting opportunities live. TSMC doesn't make products you hold in your hand. They manufacture the chips that power almost every major technology on the planet. NVIDIA's GPUs, beat made by TSMC, Apple's Silicon, TSMC, AMD's processors. TSMC. If you want exposure to the AI chip build-out without betting on a single chip designer, TSMC is the infrastructure play. Revenue grew 34% year over year in their most recent report. Advanced packaging capacity, which is critical for the most powerful AI chips, is sold out. Demand is running ahead of supply, and the company's capital expenditure plans show a management team that understands the moment they're in. The valuation is genuinely attractive. Around 20 times forward earnings for a business with near monopoly status in leading-edge chip manufacturing. Their most advanced nodes, the ones that companies like Apple and NVIDIA need most, cannot be produced at this scale anywhere else on Earth. That is moat definition. Here's the risk, and I'm going to be completely direct about it. Geopolitical tension around Taiwan is real. Any significant escalation involving Taiwan creates severe disruption to the business and the stock. That risk is not small, and it's not something you can analyze away. You have to decide how much of that geopolitical uncertainty you can sit with. For investors who have thought through that risk and are comfortable with it, TSMC at this valuation is one of the most structurally sound positions available in technology right now. Drop a comment right now. Tell me, are you currently holding any semiconductor exposure in your portfolio? I read every comment, and it shapes what we cover next. Drop it below. And if you haven't shared this video yet, send it to someone who's been trying to figure out where to put money in this market. Seriously, you might be doing them a real favor. Now let's talk about two names that are generating a lot of excitement right now that I think deserve a harder look. Rivian. The story sounds compelling. Electric vehicle manufacturer, early mover in the electric truck space, partnership with Amazon for delivery vans. There is real substance to that narrative. But here's what happens when you drill into the numbers. Rivian is not profitable. Not close. They're burning through cash at a rate that requires them to keep raising capital. Every time they raise capital, existing shareholders get diluted. The gross margins, how much money they keep on each vehicle after production costs, have been improving, but they're not yet at a level that supports long-term sustainability without continued outside financing. The competitive environment has also changed dramatically. Established automakers with massive manufacturing scale and dealer networks are now producing electric vehicles. Ford, GM, and especially international manufacturers are competing directly for the same customer. Rivian doesn't have the pricing power or volume scale to fight that battle from a position of strength right now. I'm not saying Rivian is zero. I'm saying the current valuation asks you to pay a significant multiple for a business that isn't generating sustainable profits yet, in a competitive environment that is getting harder. That combination historically leads to continued pressure on the stock, beat not appreciation. When you have other companies available that are growing profitably with clear moats, Rivian doesn't make it through the elimination process. Palantir is the other name I want to address. Here's what's real. Palantir has genuinely impressive technology. Their AI platform has found real traction with both government clients and increasingly commercial enterprises. Revenue is growing. The business is profitable, which matters. Here's the problem. The valuation is pricing in an extraordinary amount of future growth that hasn't happened yet. Palantir is currently trading at over 90 times forward earnings. Beat. Even with strong growth, that's a multiple that requires almost nothing to go wrong over a very long period of time. Any slight miss on revenue growth, any slowdown in government contract activity, any competitive threat from larger platforms, and the stock has enormous room to re-rate downward. The moat question is also genuinely uncertain. Palantir's platform is complex to implement and sticky once installed. But in a world where every major cloud provider is building AI analytics capabilities, the long-term competitive position is not as clear as the current excitement suggests. This isn't a definitive no forever. It's a strong caution right now. At the right valuation, meaningfully lower than today, Palantir becomes an interesting conversation. At 90 times earnings, you're not investing. You're speculating on a future that has to be nearly perfect. Let me bring this all together. The framework I want you to carry out of this video is simple. Economy check first. Is the backdrop okay to go? Right now, yes. Earnings growth healthy. Is there fuel underneath prices? Right now, yes. Then go stock by stock. Try to eliminate. Find the valuation problem. Find the moat problem. If you can't find a compelling reason to say no, that tells you something. If I had to rank today's picks, Amazon first for earnings momentum and cloud dominance. Alphabet second for the astonishing combination of growth rate and valuation. TSMC third for structural position in the chip supply chain. If you've made peace with the geopolitical overlay, investing isn't about finding one magical stock. It's about identifying businesses with durable advantages, paying reasonable prices for those advantages, and then having the patience to let compounding do its work. The noise in the market right now is loud. The signal, earnings growth at fair valuations, is still readable if you know what to look for. You have that framework now. Use it. This is based on research and analysis. It is not personalized financial advice. Your situation, your risk tolerance, your time horizon, all of that is specific to you. Do your own homework before you commit capital. That's not a legal disclaimer thrown in at the end. That's actually how good investing works. Do 3 things before you leave. First, smash that like button. It genuinely helps this analysis reach more people. Second, subscribe and hit the bell. We're doing this consistently, and the next video is going to be just as detailed. Third, leave a comment. Which of these 5 stocks surprised you most? Which one are you most interested in researching further? I want to hear from you. We're just getting started.